Welcome to Markets Radar with Jeremy Quintanilla. This is a show about stock markets, bond markets, crypto markets, foreign currency markets, all markets, and everything in between. And I give you my take on what it all means. Thank you so much for tuning in. And I hope that you like some of the new images that we've made on the Age of Jeremy feed. We're rebranding a lot of stuff. We have a lot of stuff in the works for content, for information coming out to you, and everything, I guess, Jeremy in this case. But if you don't know, that also entails 32 Warrior Academy is one of my main businesses, Freedom Insurance, Q Financial, Blockhead's the smartest way to track your crypto, and one of the ones that I love the most is Age of Radio, which is a media company. We have a podcast network, and we're working on some other services. We're also working on getting into the event space. We have some conferences that we're going to be going to for my show Mercury, which you can watch on Fridays at 3:30 Arizona time from 3:30 to 5. And on Fridays, I'm also on the New Wealth Transfer podcast on the Coach JV channel, so make sure that you check that out as well. But I'm really excited on where we are headed with all of this content, and thank you so much for tuning into Markets Radar. Giving you a heads up, Markets Radar will eventually be its own feed, have its own social media, have its own brand as part of a larger project that I'm working on. But for right now, you can listen to it here. So make sure that you like and subscribe. Make sure that you follow me on Age of Jeremy on all of your socials, but the ones that I'm on the most are X and on Instagram. I love both of those. And on Instagram, I have a what I call my Dope Insights and Broadcast channel. So if you want other insights and things that I have going on, then go ahead and subscribe to that, and you can be a part of that group. Getting us started today, we're going to start with energy markets. According to recent data released by Baker Hughes Company, the number of U.S. rigs drilling for crude oil rose by 7 this week, bringing the total to 452. This marks the 12th consecutive week without a decline in activity. To put that into perspective, drilling in the U.S. oil patch has just achieved its longest stretch without a drop since January 2022. Now, if you remember, back in 2025, there was a lot of anxiety in the markets about a broader shale slowdown. That fear actually spurred months of rig releases, with drillers pulling back in their operations. Now seeing 12 straight weeks of sustained or growing activity tells us that the sentiment in the U.S. oil patch is completely flipped. The trend is reversing. So what is driving this specific reversal? Well, the primary catalyst behind this shale expansion is the sustained gain in oil prices, which is being driven by the ongoing Iran war, which continues to get worse. Rather than holding back, shale drillers are now actively responding to these higher prices by putting more rigs to work. Again, this is a classic supply side response, but it's happening against a very tense geopolitical backdrop. The Iran war has introduced a massive risk premium into the crude oil market, keeping prices elevated. Shale producers are looking at these sustained gains and are clearly confident enough to ramp up their operations. So you might be asking yourself, well, what does that mean for you at home? Or what does that mean for you being an investor? First, you want to think about it if considering the companies facilitating this growth. The source data for this rig count comes from Baker Hughes, which is an oil field services company. I have been invested in Baker Hughes for about 5 years, and has been a really good return on investment because, again, I keep an eye on what's happening in markets, and then I can get into those markets as they start to unfold. And if you listen to my episode from last Tuesday, I talked about changes in the South Korean marketplace. I believe it was last Tuesday or maybe the week before. And from there, I decided to start investing in South Korean ETFs, which these are things that I talk about in my Dope Insights and Updates channel. One of the things to think about from a market dynamic is that when rig counts go up, demand for the equipment, the crews, and the services need to operate those rigs goes up as well. Second, for the exploration and production companies themselves, adding rigs signals strong confidence that current oil prices will yield profitable margins. So upstream companies with heavy U.S. shale exposure are the ones actively trying to capitalize on this current environment. And so what that means is that the primary catalyst is the Iran war. So if we see any sudden de-escalation in that specific conflict, we could see a rapid correction in oil prices, which would quickly impact the profitability of these new added rigs. And as I've also mentioned, a lot of the oil companies are sitting on a lot of cash. So that puts them in a better position to sustain themselves right now and for them to continue to grow when this problem kind of subsides. So investing in energy companies or oil companies would probably be a good idea right now. And that's one of the reasons why I subscribe to Barron's Energy newsletter, which I'm not sponsored by Barron's. It's a great energy letter that helps you understand what's happening in these specific types of markets, and so that you can find ways to invest in them. And that's one of the reasons why in our 3-2 Warrior Academy, I'm always talking to people about, look, you have to find the sovereignty over your own understanding of investments and your understanding of wealth. That's one of the biggest things that separates wealthy individuals from the middle class or from non-wealthy individuals is their ability to research, read, understand what's happening in markets, and then investing in those specific marketplaces. There's always something going on right now with the Strait of Hormuz. I'm not going to cover it every single time. I know that there was a recent bombing in Kuwait from Iran this morning, if I'm not mistaken. And again, the problem that I have with what's going on right now is I feel that President Trump is using these types of things to create certain narratives for the upcoming election cycle. Recently, he went on the news and was talking about how China impacted, I believe, the 2020 elections, if I'm not mistaken. I wouldn't put it past any country to get involved with any other countries, I guess, voting or to rig any type of election. But again, I think of this as some type of like, look over here while we do these things over here. So I just encourage everybody, if you don't read financial news, please read financial news. When I was in college, it was one of the main things that we had to do on a regular basis. We had to have subscriptions to Financial Times and Wall Street Journals. And then when I was in an international markets class, we had to read The Economist, and we had to look up sources in international marketplaces. Again, the whole idea behind how to be a good investor is to research what's going on in marketplaces and then make assessments on where you should be investing, create a plan for it, stick with it for a period of time, and then reassess it and make adjustments as needed. Now, if we switch over to Silicon Valley, we're going to talk a little bit about the mega venture capital that's going on there, as it has been going on, I want to say, since the 2000s. Maybe there's been some ups and downs. But if you want to understand how billions of dollars of wealth are generated and the massive risks taken to get there, you need to look at the people writing those early checks. So we're going to look at two contrasting but equally fascinating titans of investing, Luke Nosek and Neil Mehta. This does come from a Bloomberg's article, if I remember correctly. So make sure that you go to bloombergs.com and get a subscription. Now, both of these people have placed monumental, high concentrated bets on the future, but they're going about it very different ways. So if we start with Luke Nosek, a man who made one of his earliest and risky bets in modern venture capital, Nosek, now 51, has been immersed in tech since his days studying computer engineering at the University of Illinois. He's an original Silicon Valley insider. He met Peter Thiel and eventually helped start the company that merged with Elon Musk's business to become PayPal. Now, along with Thiel, Nosek launched the venture capital firm Founders Fund in 2005. Nosek has always been an unconventional figure. He's pretty much stayed out of the public spotlight while his partners assumed public roles. There's some stories about him famously wearing flannel pajamas around the office, snacking on fresh blueberries, and even building a blacked out soundproof box to optimize his sleep. He was also fiercely forward-looking. His early bet on the AI company DeepMind paid out massively when it was acquired by Google, and he has been a vocal believer in extending human lifespan to 150 years. And again, the reason why I bring up these individuals, now again, a lot of people have maybe negative connotation towards billionaires. What I like to do, and the reason why I'm bringing this up, is I want to have you guys understand, and also for myself to understand, how billionaires kind of think and then kind of do those things that they try to do. Like, for instance, he has been trying to optimize his sleep. That's a big part of what I've been trying to do. I've added my Whoop band. I've added my Samsung ring. These are two products that I'm very interested in as they move into maybe the public. Well, Samsung's in the public markets, but in South Korea. Whoop, I don't know if it's public, but me talking about it right now makes me want to go kind of research that, because I think we're going to have a revitalization or a growth in optimizing health and data analytics that go into health. And that could be something that maybe you want to go and research, because maybe that's something that you want to add to your overall portfolio. Also, Google Notebook LM is one of my favorite products. It's just recently been changed to Gemini Notebook. I think that's fantastic branding change, and I'm going to continue to use Gemini Notebook, and I recommend you do as well. Now, Nosek's defining move came in 2008. He became Founders Fund's biggest believer in SpaceX, a company that was 6 years old at the time and had not yet proven it could launch rockets cheaply enough to revolutionize the industry. Nosek pushed through a $20 million investment, making up roughly 10% of the firm's second fund, and joined the SpaceX board. The other reason why I want to talk to people about this is because my hope is that there are inspiring people that are listening to the show, or people that want to understand markets better. And again, there's venture capital, there's private equity, there's credit markets, and I want to kind of provide an introduction into all of these things so you can start thinking about how people think in this space. And as you grow your wealth, then you can start to maybe do these types of things or find ways to get involved with them, or at the least know about these companies, go and follow them like I follow Y Combinator, and find out what's going on in those spaces so that you can stay up to date, because getting wealthy is all about getting information. Now, if we think about Nosek, he wasn't just throwing a dart, right, and finding something that would stick. He was betting on a massive chunk of his fund on an unproven rocket company during a very turbulent economic time. Now, this was obviously probably highly controversial, as it might even appear to be highly controversial now. But if you remember, SpaceX just went public. Now its stock is going down. I think it's going to go all the way down past 100 or somewhere around there. And then I will probably enter into SpaceX. But at least one limited partner in Founders Fund outright refused to invest in their next fund because they were so unhappy about this massive wager on space. But again, conviction and integrity pays off when you believe in something and you hold to that conviction, right? And SpaceX used to be, when SpaceX was valued at around $400 million, that was back in 2008. That if they had any liquidity, they needed to get in. He was telling everybody about this. He famously said, "I've never believed in anything more." Now, the takeaway of retail and institutional investors here is about the power and the danger of backing a visionary. Nosek eventually left Founders Fund in 2017 to start a new firm, GigaFund, specifically so he could make even larger bets on Elon Musk's companies, including Neuralink, The Boring Company, and pouring over $1 billion into SpaceX. Today, the SpaceX stake is worth tens of billions of dollars. He leveraged insider access and absolute conviction into generational returns. And those are the things why you have to understand what's going on in the world so that then you can make an assessment on what the next best big bet could be. Now, you may not be in a specific position like he was, where you're at the forefront and you have the access to get into the venture capital space, but you can. There's so many stocks that are out there. That's the marketplace that we've created inside of capitalism, this free marketplace of being able to buy and sell shares of companies, which again, if you go and research all this, you can find some really big winners in this space. Or even listening to this, maybe this gets excited about you for SpaceX and you get into SpaceX and it goes from $100 a share or $120 a share to $300 or $500 a share, and then you've just, 4x your money in that sense. Now, there's another founder that that contrasts with Nosek, okay, that focus was a different kind of whale. His name was Neil Mehta of Green Oaks. Mehta is 42 and cut his teeth at the hedge fund D.E. Shaw before co-funding Green Oaks in 2012. He grew up in Silicon Valley with engineer parents, and he was so interested in business that for his 14th birthday, he asked for a trip to Omaha to attend Warren Buffett's annual shareholder meeting. He even started a social networking company in high school, which failed when the dot-com bubble burst, teaching him early lessons about entrepreneurship. Green Oaks built a massive reputation by making concentrated bets and doubling down on winners over a decade, backing heavyweights like Palantir, Stripe, and the South Korean e-commerce giant Coupang. But recently, Mehta has commented and this is Mehta, that's his name, not Meta, has cemented his status as a leading investor in the AI boom. He has won incredibly competitive deals that used to be reserved for legacy Silicon Valley firms. Green Oaks invested in Anthropic earlier this year and co-led a funding round just months later that valued the AI company at a staggering $965 billion. Meta's firm now holds a multi-billion-dollar stake in Anthropic, alongside key investments in Elia Suskever's Safe Superintelligence and Brett Taylor's customer service AI startup, Sierra. And Brett Taylor's customer service AI startup, Sierra, I would bet that OpenAI is going to probably buy Sierra. And so I don't know what Sierra's stock is trading at, but that could be a good potential play. And I think that it would be a good purchase for Sam Altman for OpenAI. And if they could put Brett Taylor as the CEO and have Sam Altman step over to the board, I think OpenAI might have a better chance in the future. But right now, Anthropic's destroying everything. Now, if we think about the landscape here, it gets incredibly interesting for anyone tracking the markets. Meta actually keeps a list of S&P 500 companies on a screen in his San Francisco office, and his stated goal is for 100 of Green Oaks investments to eventually make that list. Again, one of the reasons why I wanted to go deep into this with people is so they can understand the venture capital markets. Plus, I'm working to understand the venture capital markets as well, because again, as I build my wealth, I would like to get more into venture capital and start some type of fund in this specific capacity. And so the thing that I like about this is he has that really big focused goal that one of his companies is going to be an S&P 500 company. And he has that essentially as a vision board that he sees every single day, which to me, that gets kind of exciting thinking about that. And also too, myself and my partner tonight, we're going to work on our family vision board. And I recommend, I know you might think it's ridiculous, maybe vision boards, I don't know. But if you think about what he's doing, that's no different than a vision board. You set up your goals around you so that you can constantly be seeing them, so you can visualize them, so you can stay on track for what you're trying to do. For investors, Meta represents the aggression, momentum-driven strategy required to capture the current AI gold rush, which again, we're at the gold rush. We're getting into the infrastructure stage where companies are going more and more into the infrastructure, and eventually all of it will pull back heavily. Now, he isn't betting everything on one founder like Nosek. Nosek's put most of his stuff into Musk, but he's identifying the foundation pillars of the next tech cycle, like Anthropic and Safe Superintelligence, and doubling down heavily. He's applying Warren Buffett's philosophy of holding highly concentrated positions, but applying it to hyper-growth private tech companies. So again, he has a specific plan where he is, again, applying it to hyper-growth private tech companies, and he just focuses that on his specific fund. And that's kind of one of the things that you want to think about too, is you're building out your portfolio. Your portfolio should have a specific thesis. So for example, my portfolio for my dividend strategy is to have a certain amount of risk, a risk associated in different specific types of buckets. And then as far as what the mid-tier is, are broad ETFs, okay, that focus on high-paying dividends with low volatility. And then for the aristocrat stuff, to only be in aristocrat-style stocks that have an increasing dividend over time in specifically consumer staple type of investments, so that those investments can balance out the overall volatility of the exact portfolio, so that I can get a base of a certain amount that's paying me out a regular dividend every year and not losing on the original money that I put into it. Not focusing on growing it, just focusing on not losing it, so I could have higher risk dividend plays inside of it. That is a specific strategy, and you could even go deeper into that strategy, and I might go deeper into that strategy as I play with another portfolio, or as I go into my venture fund, I will focus, or private equity fund or whatever, I'll focus on a specific niche and not kind of be broad. You need to be specific on what you're trying to doing and just focus on that specifically. There's a massive warning sign flashing here, though, that every investor needs to heed. With these massive valuations comes intense scrutiny. David Mann, the chief executive of the Mansion Group, recently pointed out a critical concern. How will these firms actually monetize these holdings. Okay. Now the firm doesn't need to actually monetize the holdings because their purpose of them is probably for the growth piece of it and then to get some revenue from it. But that is one of the biggest problems that we're seeing in the AI space is that everybody's putting this large capital expenditure into the AI space and there's not a lot of profit that's coming out from it now because the costs are too high and people need to, they're kind of switching between stuff, right? A lot of the big plays was like consumer to consumer. That was vis-a-vis ChatGPT. People realized that they couldn't get all of their money there. So then they started going into this business to consumer space or consumer to or business to business space, which Anthropic does really, really well. And then now we're getting more into the infrastructure space because the market's so mature and it's moving so fast. We kind of have to figure out what it actually looks like and how can you make revenue from it. So then that revenue then would pass on to these funds. But my guess is more of these funds are waiting for that piece to happen for these to grow and just get one or two that win. Like in Mehta's case, in Mehta, the gentleman, the case is that again he wants 100 of their investments to get on the S&P 500. That's how they're going to make the biggest bang for their buck. But again, companies have to learn how to be profitable at some point in time. Both Nosek and Mehta have generated astronomical wealth through concentrated bets rather than broad diversification. But right now, a lot of his wealth is locked up in private markets. As Mann points out, there's a huge difference between paper profits and actual gains. These massive returns are largely tied to the investors' close personal access to founders like Elon Musk or the elite AI circles. Will they have the same access to the next generation of entrepreneurs? And this is one thing I want everybody to take away from here before we go to break, is that most of the time, these things are luck. I think Mark Cuban does a great job on a recent episode of a podcast that he was on with Trevor Noah, where he says, look, if he was doing it right now, he probably would be a millionaire, maybe even 100 millionaire, but no way would he be a billionaire because you have to be at the right place at the right time, doing the right thing. And a lot of that is based off of when you're born and the people that you are born around. So luck does play a part in it, and I actually agree with that. But you can also continue to put yourself in places where more luck can show up. And again, I think people underestimate the $1 billion, but I don't think that you should stop telling yourself that you are going to be a billionaire or a trillionaire because you can move yourself forward. Just like Age of Radio is going to be $1 billion, it is $1 billion value-weighted independent media company. It's going to be the largest one in the world, and it will be on the NASDAQ 100. We'll be right back.
Teens share everything. That may include the bacteria that can cause meningococcal disease known as meningitis. Even if your teen's been vaccinated in the past, they could still be missing meningitis vaccinations. Ask your teen's doctor or visit meningitis.com today. Sponsored by GSK.
Moving from tech to fintech. Again, we don't talk about crypto enough on the show because there's all these other cool markets that are going on. And a lot of money has been coming out of the crypto market, going into the AA market. And crypto is a wild ride right now. If you are into crypto, make sure that you head on over to merlincrypto.com and get your 30-day free trial of Merlin, where you can see all of your coins in one place. You can see entry target, you can create exit targets, you can create entry targets. And there's no better tool than Merlin. So without going super deep into it, go to merlincrypto.com, look into it for yourself. It's a company that I own and I helped create this, and we have a lot of cool stuff in store. So go and check it out. You will not regret it. I promise. But talking about fintech, the new system, Visa Stablecoin Platform, it's called VSP, which is currently rolling out to a select group of beta customers. This new system is designed to allow financial institutions to seamlessly issue, transfer, and manage stablecoins across blockchain networks through one centralized hub. Initially, the platform will support a token called OpenUSD. The stablecoin is issued by Open Standard, a powerhouse industry consortium backed by Visa, backed by BlackRock, backed by Alphabet, and backed by Coinbase. I'm reiterating this right now. Cryptocurrency isn't going anywhere. I'm not going to say you're going to become a trillionaire in cryptocurrency, but you have to understand how it works. It should be a part of your portfolio. Read about it. Understand blockchain technology. It's going to get more integrated into our current financial system. So don't get left behind. That's what I'm telling you right now. So what does this mean for investors? Because this isn't just another crypto token launch, this is a structural shift in a massive market. Stablecoins, which are digital tokens pegged to steady assets like the US dollar, have evolved into one of the most successful products in the crypto sector. We're looking at a market currently valued at over $310 billion, and Morningstar projects it could surge to an astounding $1.45 trillion by 2035, largely driven by cross-border payments and remittances. What investors really need to watch here is the business model disruption. OpenUSD's strategy is to eliminate minting and redemption fees, returning nearly all of the reserve income back to its partners. If it's successful, this is going to shift the immense value created by stablecoins away from the companies that issue them and directly into the pockets of the companies distributing them. For traditional banks and fintechs looking for a way to transfer money 24/7, Visa is building this institutional grade plumbing. They need to finally adopt blockchain technology. Following Visa's announcement, shares of Circle, the company behind the second largest stablecoin USDC, dropped by as much as 6%. Coinbase, which has an existing partnership with Circle, but is also backing this new open standard consortium, saw its stock fall 4.5% at one point. Meanwhile, Visa's stock enjoyed a boost, rising nearly 2%. As an investor, you have to weigh the disruption risk to pure play crypto companies against the upside for legacy payment giants. As Visa's chief product officer, Jack Forstell, noted, they are giving clients the ability to handle stablecoins with the specific controls, security, and network reach they already expect from Visa. The smart money will be watching to see if legacy networks like Visa can successfully capture this multi-trillion-dollar blockchain volume, potentially squeezing out crypto native issuers in the process. And again, I want to reiterate, cryptocurrency is not going away. Now, in my personal opinion, I'm what people would consider an anarcho-communist or a communist for the most part. And I'm not talking about the communism that you see in North Korea, the communism that you see in China. I'm talking about where the people have the ability to create and operate something owned by all of the people, like a cooperative. So I'm okay with free markets. I'm not saying that we should take over private ownership. People misconstrue what private ownership means in a communistic or a communism way. And hopefully I can work to educate people on that as we move forward. The problem with this is the fact that the larger companies are going to integrate this. And what was so exciting about blockchain technology, and can still be exciting, is it allowed people like you and me to understand how to do programming, utilize some of the infrastructure like Stellar has, create our own payment pathways, create our own ability to have liquidity pools, and essentially create our own bank and be able to live outside of the giant largest banking system. So what the banks have been trying to do over these last couple of years is make sure that they control that power so that people still have to use them in some capacity, which you would still have to use them in some capacity anyways, because we still move dollars around. But as more things move to this the open USD standard, is that we're going to see a lot of more tokenized coins being able to be out there so that we start getting better. They're going to try to push us essentially into utilizing digital tokens. So it's going to be integrated in our society, and the dollars will slowly essentially move to the wayside, and they will still have all of the power. So the reason why I'm telling you this is you and whoever's listening to this, please don't get left behind as this continues to grow and get better. And then also for any entrepreneurial spirits out there or software developers, go and understand how to build your own type of infrastructure using some of the nonprofit foundations that are out there, or the foundations that are out there like Stellar. Stellar is probably one of my favorite projects and one of my favorite cryptocurrencies, and it is allows you to create payment processing either for nonprofits or for profit purposes. So again, go research, understand it, and we'll be right back. Gonzo on the New Wealth Transfer podcast, he says that there's a market everywhere. And this story that I found by Bloomberg. So again, go get Bloomberg's. I use Bloomberg, Wall Street Journal. I have Barron's. I have Market Watch. The only thing that I don't have that I wish that I had was Financial Times. And I need to renew my subscription to The Economist because it got canceled when I had fraud on my one of my business accounts, and those accounts the debit cards and cards got shut down and the account moved over. Point being is that this is about dinosaurs. And I love dinosaurs. In fact, I was at Sedona a couple of months ago for some time away with my partner, and I actually almost bought a Triceratops head for, I think, no, a Triceratops. What it was either a Tyrannosaurus Rex fang or it was a Triceratops skull for like 50 grand. And I almost did it because I would have had a part of a dinosaur. Again, dinosaurs are awesome. And who wouldn't want to have a dinosaur? In recent years, dinosaur skeletons has transformed into a highly coveted asset class for the ultra rich. Now, I am essentially on my way to be ultra rich. I would consider myself rich now, sharing the same rarefied air as sports franchises or fine art, which has always been one of my dreams, is to own dinosaurs. But the thing is, I wouldn't just seclude them from myself. I would start my own like little museum, have an art gallery, open that bad boy up. People could come and see it, maybe put it on loan to the Phoenix Art Museum to show it or something along those lines. That's the problem that I have with some of the ultra rich. As billionaire Dan O'Dode, who bought a T-Rex for a bargain $600,000 in 2009, put it, it's the best trophy kind of thing you could own, and I agree with him there. And the valuations have absolutely skyrocketed since then. In 2020, a T-Rex named Stan sold at Christie's for $31.8 million, obliterating its $8 million high estimate. Just recently in July, Sotheby's auctioned off a T-Rex named Gus for a staggering $50.1 million, setting a new record. It isn't just T-Rexes either. Financier Ken Griffin recently dropped $44.6 million on a Stegosaurus. Dang it! That would be so cool. What are we witnessing here, though, is the aggressive financialization of a brand new alternative asset class. So when we think about markets, one of the asset classes that we can think about are alternative asset classes. So traditionally, we think of those, the ones that come off of the top of my mind would be art, wine, alcohol, and pottery, maybe, which would be an art. But there's these other alternative asset classes that have really good, can be really strong because billionaires have access to them or very wealthy people have access to them. So even when things are going bad, these types of markets for these alternative assets can still do pretty good. One of the ones that I do is the fine art. I invest in a company that is escaping my mind right now, but it allows me as an accredited investor to buy shares of really high art, and there's a marketplace on it to buy and sell those shares with other individuals. And also getting into physical art, which for the most part has kept up with inflation from the last time that I did any research on it. But let's go back to the dinosaurs. When high net worth individuals find conventional art markets too fussy or convoluted, excess liquidity starts flowing into these exotic, tangible trophy assets. But this is a critical takeaway. For anyone looking at alternative investment, this market has virtually no regulatory oversight or professional standard. It's what we would consider the wild, wild west. Kind of how crypto was back in 2018. The value of these fossils derives from a murky mix of provenance, market desire, and authenticity. And in the auction world, the burden of verifying that authenticity falls entirely on the buyer. If you are allocating capital to unregulated alternatives, whether it's fossils, fine wine, or rare collectibles, the pricing premiums are massive, but the foundational metrics for valuing them are incredibly subjective, right? Because it is an alternative market. The subjectivity of this market recently caused a massive implosion on the global stage. In 2022, Christie's was set to auction a T-Rex named Shin in Hong Kong with an estimated price tag of $15 million to $25 million. But just before the auction, a group of paleontologists and fossil experts noticed something weird about it. Finding a complete T-Rex is virtually impossible. They are usually filled in with synthetic casts made of fiberglass or resin. Experts looking at Shin realized the skull looked exactly like that cast from Stan, the T-Rex that sold for $31.8 million, which this is a massive problem because a commercial fossil hunter named Peter Larson actually owns the intellectual property rights to Stan and his cast replica, and he vigorously defends that copyright. Facing immense pressure and legal threats over intellectual property, Christie's was forced to cancel the high-profile auction entirely. Behind the scenes, individuals like Martin Jenkins, an advisor to the ultra-rich, have been trying to package these dinosaurs not just as bones, but as cash flowing businesses. Jenkins pitched museums on splitting admission fees and merchandise revenue, and marketing documents for his specimens boast that the exploitable IP narrative and brand from these specimens is almost limitless. And perhaps most important, investor takeaway, the absolute necessity of due diligence and understanding the underlying mechanics of what you are buying. In the bone rush, investors are just buying old rocks. They aren't just buying old rocks. They are buying a percentage of completeness, which is heavily debated. In a bone reel, is a bone real or is it a 3D printed cast? If it is a cast, who owns the intellectual property? The Shin auction cancellation is a textbook example of catastrophic diligence failure. A buyer was ready to drop $25 million on an asset that was heavily padded with synthetic materials and which actively infringed on another company's copyright. Furthermore, while the pitch of limitless IP and museum ticket revenue sounds great on paper, traditional public museums often reject these profit-sharing models. Ultimately, whether you are investing in tech startups, crypto, or $66 million year-old apex predators, the lesson remains the same. Do not let the hype outpace your due diligence. If you can't verify the authenticity, or if you can't verify your willingness to stay in something for a long term or to take on that risk, you really aren't making an investment. You're just buying something that could be expensive or something that you are just chasing money for. And the goal here is to hold things, build an actual portfolio that's going to last and that's going to help you create generational wealth. And with that, as I always say, be thankful, grateful, and kind. We'll talk with you soon. Bye.